to TheoTrade. This is Don Kaufman, June 19th, 2020. Minutes to go on this Friday afternoon as we're doing the weekend update. Massive ranges, minimal movement. That was really the theme of this past week of trade. Wait, what does that even break down to? When I say massive ranges with minimal movement, one of the things that I've got to mention right up front, incredibly frustrating to trade in this past week simply because the biggest moves were in the overnight range. And again, that's not something, that you're going to be proud of as a trader. But if you trade futures, you should just wake up at 3 o'clock in the morning, buy that marketplace at 3 in the morning and ride with it. What I'm talking about here with kind of massive ranges and yet minimal movement is, again, the S&P futures, and I'm going to zoom out for a second and go to a daily chart. The S&P futures throughout the course of this week of trade, again, I think that this is perfect to represent that. I mean, here's a trade all the way roughly down to 29. 25. The S&P futures, this is actually on Sunday night into the Monday night evening. They were actually down 98 points by the end of the day. They were trading right back up here where you're just shy of, let's call it 3070. I mean, again, they're staggering ranges. The same thing on Tuesday. All right. And again, I can go day in and day out over here where you're getting these just absolutely immense ranges. But hey, net, we popped to the upside on Monday. What did we do the rest of the week? Absolutely nothing. Minimal movement, again, with massive ranges, though, being thrown off. And that's one of the things I was mentioning like last weekend on the update is keep your helmet on, people. This is not per se healthy price action for a marketplace. By the way, I also would like to address any of the conspiracy theorists out there. I've had a boatload of emails this week. People are like, it's the call buying, it's inexperienced traders buying calls that are running the market higher. Well, that would absolutely not describe why the market drives higher in the overnight session. There's no calls to trade at that point, people. Just for the most part, S&P futures order flow is driving us a little bit higher. And net, I think the interesting thing from this week of trade, and I'm going to snap here to a 30-day 1 hour. The interesting thing, we got bid up at night, we sold off during the day. We got bid up at night, we sold off during the day. We got bid up at night, and we sold off during the day. I mean, how many times in a row can you see this? But again, the range here is expansive. It's definitive. It's huge, right? Again, you cannot complain as a trader about some of the ranges that you've seen throughout the course of this week. But in the end, we just got minimal net movement out of it. In fact, to put this into context, one of the things that we're going to look at a little bit later here in this video is, of course, the expected move. And, we popped, and then that was it. That was it. We popped here, and then that was it. When I say that was it, we popped to the upside Monday, Tuesday, and from there, it was over, people, where we literally traded, right around the that range of about 3,100 on the S&P futures. Nevertheless, let's actually move onward and upward because I've got quite a bit to discuss, of course, in this weekend's update. The next thing I want to cover here is we actually see at the closing bell. This is quite interesting. Heavy volatility into the closing bell here just moments ago. Nobody saw that one coming. I'll tell you what, this is actually going to be persistent here. And we're going to drive even lower in the after hours. So some heavy order flow to the sell side activity, of course, right at the closing bell with some monumental contract size. The other aspect that I want to address that came up in emails a lot this week as well, before I go too detailed into some of the bullets over here, people are like, it's quadruple witching, duck and cover. Quadruple witching and triple witching, it hasn't meant really anything, okay, for the last approximately 10 years of my career. And when I first started trading in this business in the late 90s, you better believe it. I mean, the trading floor was a rockin', the SPX, the OEX pit, they were rocking back in the day, during an expiration Friday. But listen, when it comes to the SPX, every week is an expiration week, and the SPX goes off of the opening print, so yada, yada, yada. Quadruple witching means very little. Was the volume staggeringly large because of quadruple witching? Okay, we did 1.8 million contracts inside of the S&P futures. Is that even big? Okay, and the answer is no. Come on, it was a quadruple witching. It was supposed to be huge. Look, the volume is minimally more than it was the day before. It's actually a little bit less than the day before that, but here's actually the contract roll. So that was the big boys. Anyway, the point I was making with that is don't necessarily buy into everything that you hear about like triple witching and so forth. Yeah, a little bit of a conversation piece right at the cash open and right at the cash close. Other than that, absolutely nothing. So as I was saying, the overnight ranges very, very frustrating, because the S&P futures did the mass amount of movement this week overnight, right? And then they would just kind of reverted back, neither here nor there. Maybe next week we'll just wake up in the middle of the night and start trading. The next thing I really want to focus on, and this is one that's it's kind of been a fun topic, because hey, I'm going to tell you right now, here again, and I've been reiterating this is going to be the third week in a row that we're talking about it, the monsters of tech. And by the way, the monsters of tech, if you're uninitiated, it's Facebook plus Apple plus Microsoft plus Google plus Amazon. All right, so it's a conglomerate symbol that I built. And the monsters of tech, they will not die. Why will they not die? It doesn't matter why they will or they won't. If these S&Ps, which I told you, they're going to go down a little bit here into the after hours, if those S&Ps are going to dive, it has to be done on the back of the monsters of tech. And this has to do, in very large part, it's about market capitalization. This is not about my undying need for these stocks to sell off. By the way, I do not have an undying need. I am carrying positions. In fact, in a moment here, I'm going to talk about position breakdown. I am carrying positions. And why am I carrying positions in so many of the tech stocks? And by the way, to further that, I am carrying short positions in tech. Why am I willing to sustain the pain? Because I love the risk reward. That's what it's about for me. It's about risk reward. And I wouldn't do this if I didn't think that the reward was going to be viable. Nevertheless, I will reiterate once again, when people keep asking like, why don't you just wait for them to begin to sell off and then short the marketplace? Oh, you mean that I should try to move hundreds of thousands of dollars into place in the middle of a sell-off? Kind of like we did, like last Thursday. We sold off big last Thursday. And you know what? If I had gotten in on Thursday, I would have gotten my face ripped off just as badly in there. But the thing is, okay, if you want to be in for the big move, you have to be in before the big move. I'm going to say that again. Okay? If you tell me like, hey, I'm going to market time in this, so I'm going to wait for the market to sell off. Listen, you can do that, but you can't do that with substantial capital. You just can't. And I'm going to tell you right now, I'm trading with some substantial capital. And when it comes to it, you can't just shove, $750,000 or $1 million of positions into the marketplace and be like, it's going to sell off. Let's just get in front of it. I've been building a position for a substantial period of time and sustaining that position, which is exactly where we're going to come to. But again, the monsters of tech, are they going to die? All right. If the sell side activity is going to get real, like if it's going to get real out there, you're going to feel it. And you're going to feel it in these underlyings. And why you're going to feel it in these underlyings, okay, there is no other way to pull the S&P 500 down. You got to realize, like Microsoft now, which is down here, and Apple, okay, each have market caps of $1.5 trillion. $1.5 trillion each. That kind of market capitalization, like it doesn't matter. What other stocks are doing in the S&P 500. We could talk about the S&P 500 or the S&P 100 to your blue in the face. All you got to worry about, right, is the top 5 or the top 10 stocks inside of the S&P 100. And quite frankly, a lot of those are the monsters of tech. And right now, they will not die. Speaking of will not die, as I said, likely to see some sell-side activity persistent even after the bell has gone off over here. And it's, I don't know about you, but I kind of like the project. S&Ps. Listen, just a moment ago when we started this video, they were down like 8. Now they're down 30. Now how's that for volatility? Massive ranges, minimal movement. I don't know about you, but that movement's starting to pick up. So the monsters of tech, again, they're pivotal in this. Absolutely pivotal. So when you're looking in the after hours, and I want to show you this in the after hours, look, Microsoft is actually coming off over here. Okay, Apple seeing a couple of trades to the downside, but net, okay, this is in a big way. This is the S&P futures. But remember, for the S&P futures to move down, for the entire market to move down, it's got to be done on the back of the monsters of tech. The next thing we're going to talk about is a little bit about position breakdown. It's been a while since I've actually done this, so let's get down to it. This is going to take a little bit of time, so sit back, relax, okay, follow along. One of the first things that I want to do in here when I talk about a position breakdown, I don't want to explain, okay, I'm going to explain a lot of my positions. And I'm not going to go into too detail like this trade, that trade. I want to explain my positions. First and foremost, I think there's a great opportunity in the volatility index. The great opportunity is simply this. All right, I'm going to open up like a 3-year, a 5-year, 10-year, it doesn't matter. Here's a 3-year, okay? I'm going to take outside shots up here. That's it. I want to take outside shots up there. Why? Because they're cheap. They're dirt cheap. I don't believe that the VIX is going to fall back flat on its face back down to 10. I don't think the VIX is getting much under 20, maybe even 25. So I'm going to take outside shots. How do I take outside shots? What I'm actually doing right now is I'm financing the outside shots by selling put spreads. Net, this is what it actually looks like. I'll sell a 20-15 put spread to turn around and buy a 65-100 spread. And that's actually be done. That trade is actually being done, okay, for net even, meaning that, when I put this trade on, I was selling the puts, buying the puts. That's a $5 wide spread. So I'm selling a $5 wide spread to buy what? A 65-100. Now, does the VIX have to get to 65 or 100? No, not necessarily. My spread can still explode in value without it necessarily getting up there. But that's the point that I wanted to make. I'm looking for an outlier event. Because quite frankly, you look at the marketplace and everybody's saying the same thing. They're like, oh, it feels so disconnected. Like, I get it. The jobs number comes out and you're like, whatever, man. Don't worry. There's only 20 million people that are out of work. And then, the next number comes out. You're like, oh, the retail sales were better than expected. They still are absolutely horrible, but they're better than expected. It feels like this huge disconnect between the market and Main Street. And of course, then we start convincing ourselves it's the Fed. The Fed has done it. Yeah, well, guess what? Okay, I don't really care. I don't care. And I'm going to take these outlier shots. You know what? If I hit one of them, gold, Jerry, gold. And that's the idea. All right, an outlier shot is, hey, everybody's looking for the possibility of volatility going up. Yeah, what happens if it absolutely explodes? I want to be part of that project, okay? And I don't want to pay anything up front for it, so I did the trade for net even. That's a volatility. The next thing I actually looked at, I just actually popped a couple of these on today. I'm actually buying some volatility here in the XLF. To describe that very specifically, I'm using calendar spreads. I'm like selling July. I'm selling July and I'm buying SEP, which makes me net long Vega. Now, when you do something in the XLF, like I had to do some pretty serious size in here. It's trading at 24. But what I have here is I'm buying back month vol. And you're like, why are you buying back month volatility? If you take a look, like front month vol here is almost to 50. The back month vol is about 44. So it's nice. It's inverted and so forth. And what also, comes into play, and by the way, I'm not trying to sell higher vol and buy lower vol. Forget that crap. Okay. What I'm really trying to do is we're in a very low instance, thus far. Okay, in the last 52 weeks, the IV rank is 27%. So I'm trying to buy low volatility because I think if volatility is going to hit the marketplace as a whole, it's going to be felt in a huge way once again in the financials. Why? Because, when the proverbial crap hits the fan, it usually ends up in the lap of the financials. And that's why I want to buy volatility in the financials. Enough said over there. Okay. Next thing I want to talk about is understanding my shorts. So yeah, you can only get away with some of that when you're talking about the market. Understanding my shorts. I've got a couple of short positions on. I'll start with Caterpillar. Caterpillar is pretty easy. I can talk about fundamentals till I'm blue in the face. Caterpillar has tendency to follow in large part the S&P 500. But one thing I like about Caterpillar, it has categorically speaking been incredibly volatile. And I want exposure to the short side of Caterpillar simply because this is not like a big valuation. I don't want to talk about fundamentals. Okay, if the market's coming down, Caterpillar is going to get absolutely decimated. And that's it. I mean, and I'm using longer duration, deep in the money puts. This is synthetic. This is a synthetic short position. Okay, I'm not shorting the outright stock. I don't want to short the outright stock and end up paying the dividend. Okay, I just want short exposure in here, and I use a deep in the money put. I've had this position on, again, minimal amount of time. We're just off some of the recent highs over here. That's one that I want to maintain. The next one I actually want to talk about is CSX, trains, planes, and automobiles. I feel the same way about CSX that I actually do in terms of Caterpillar. I want to be exposed, okay, to lower volatility. This is lower volatility. If you saw Caterpillar, Cat had a little bit more vol, but if you take a look at something like CSX, it's a train. Okay, if the economy is not doing so well, they're absolutely going to punish the train. So deep in the money puts is there as well. And again, I don't want to make a huge fundamental argument. I'm trying to actually be very selective, if you will, about where I'm creating the short positions, lower volatility and higher volatility, products to net out a little bit even. Speaking of lower volatility products, okay, the next one I want to bring up again, and I'm trying to go broad spectrum across the economy here. This happens to be the XHB. Now this one, I just reinitiated the XHB short, and I'm just reinitiating it this week. And I want to reiterate this one because I think it's very important. If you take a look at the home builders, all right, let me close up this left side bar and just get right down to it. I've been short the home builders before, okay? And I was short the home builders right into the COVID crisis. But I shorted the home builders, okay, all the way back in this time frame, and this time frame, and this time frame. And I shorted them in a heavy way. And I don't mind saying, I shorted them all the way back here. When they were back at about $42, I shorted them and I carried a position all the way up here to almost $50. Why am I telling you that? Because I closed them, I believe it was on March 12th. I closed them on March 12th, right? And on March 12th, it was an absolute grand slam home run. Guess what? I just stepped in, okay, right here again at the 45 level. So what am I doing? The exact same thing I was doing before. And this is where people are going to come in and they're going to argue. The interest rates are low. And listen, I don't care about that argument, right? That's not gonna sell me on not wanting to carry a short position. The interest rates can be what? They're going to be low for the next couple of years. Does that mean that the home builders are going to perform? A lot of the home builders, if you look at this ETF, it's not about like Toll Brothers and so forth and like a Pulte. This home builders actually carries like, stuff that goes in your home, like large appliances. Okay, take a look what's in the XHB, right? So, large appliances, Lowe's, Home Depot, that's the kind of risk that I want exposure to. And that's exactly what I'm getting out of here. And again, I love the risk reward of this. I mean, this thing has been straight up. And if there's going to be an economic slowdown, and maybe it's 20 million jobs, okay, right now, and that could actually diminish, that doesn't matter. That kind of unemployment, okay, it just, to me, can't be good for the home builders. And I'm not going to, argue, again, fundamentals any further than that, because this trade is less about fundamentals and more about risk reward. And I don't know about you, okay, but I don't feel like we're going to recover from this. And the way I look at it, this is pricing in a perfect recovery. Like that everything is going to be fine, just as it was before any of this happened. And I'm sorry, I'm not buying that kind of argument. All right, so that's XHB. The next one on the docket here is Walmart. Okay, now Walmart. Ooh, you're like, I can't believe you would short Walmart. I had to have some exposure to consumer staples. I started the exposure to consumer staples right in the middle of like the COVID crisis, because I'm like, listen, eventually people are going to be like, I don't want to buy any more toilet paper. But that was not the reason I got short. The reason I actually shorted in here is simply in respect to the fact that I think that online and retail sales in general are going to start to get tagged. Eventually, there's going to be an impact to the bottom line economy. I mean, that's what all these short positions are about. So obviously a short inside of Walmart. If you're not comfortable with Walmart, you could use the XLP. The XLP, very, very similar position. Inside of the XLP, you can see I've got some deep in the money puts. I've got some other puts I need to roll in here, but the XLP is, again, consumer staples. So the consumer staples have almost completely recovered to pre-COVID kind of pricing out there. When you look at consumer staples, it's retail. And retail, come on. We all recognize that retail's got huge exposure. On the list as well, okay, Intel. If you take a look at Intel, also almost a complete total recovery. Intel's actually a lot of news possibly coming out on this next week. There's a discussion between them and Apple. Nevertheless, this is actually starting on my tech Okay, I am carrying a very mild short position inside of Apple, a larger short position inside of Facebook. And again, these are where I need to be able to sustain the position. And when I say sustain the position, these are what I believe offer the most incredible risk reward available inside of the marketplace. And again, good, bad, or indifferent. I'm showing you guys my positions. You may not love them, and that's fine. And I think a lot of people come back at me and they're like, well, okay, well, what? Listen, as I said, I am building, if you will, investments to the downside. Okay, you don't look at this as a short-term position. When I'm out there and I'm talking about duration, when I'm talking about going into Facebook and shorting it and using September options and using deep in the money September options, you better believe that I want to create a short position, and that's not something that I'm going to hold for a week or a month. The absolute minimum is 3 months. I held Boeing for 2.5 years before Boeing collapsed. Okay, and I'll tell you what, people ask, why Apple? With everything they have going for them, why Apple? It has nothing to do with Apple. You want to know why I want to short Apple? Because there's the exact same reasoning as Boeing. Apple is now the single most important component of the Dow. If the Dow is going to fall, Apple's going to fall. Bottom line, if the Dow is going to fall, Apple's going to fall. And you should be aware of that. So Apple's my new Boeing. And I am going to continue to press into this some short positions. So that's understanding my shorts. Understanding my shorts. Next, okay, I'm a backspread maniac. I'm still maintaining a couple of backspreads here and there. There's a new one I actually put on inside of a ROKU. This is actually a cool one. I put on a bearish ROKU position, and I used a backspread to do it. I didn't want to be bearish. But the skew was actually favorable to be bearish. So this is a bearish ROKU backspread. You could do the 125, like 110, like backspread. I think I put it on for like a $2.40 credit. Clearly, I also did like the 130, like 115. I spread some allocations out, but I put it on for a credit. So here's the bottom line with the backspreads. And I got to tell you, my backspreads have done really well. Like I've hit backspreads again and again. I am a backspread maniac, as I said. If ROKU flies to the upside, I'm going to keep a $2.40 credit. If ROKU comes down, but it's got to come down under 100, I could have some really big time profitability. But I'm going to tell you right now, everything pretty much between 100 and where we're currently at is what I would call scary. That would not be a good place to fall, but we'll mitigate our risk, of course, by closing the trade well before expiration. So that's ROKU. I'm also sustaining some positions. I've got some backspreads, upside backspreads inside of Microsoft. For those of you aware, maybe unaware, and I'm switching back and forth between an IRA and a portfolio margin account. Here's actually a backspread. In fact, I even pulled one of these off earlier today. I'm short Microsoft. I'm actually short Microsoft, but I'm using backspreads to mitigate my risk in case we explode to the upside. Kind of cute, kind of nice. I like it. I've got a couple backspreads in the TLT. Outlier moves. Here, let's talk about this for a moment. Outlier moves that continue, but you got to see what I'm about to show you. Here's one of the interesting things about outlier moves. Okay, we're actually going to use and apply what they call auto expected moves. What I want to show you this week is, I think, of critical importance. Auto expected moves. Okay, this is the QQQ, the Nasdaq. Nasdaq, okay, crested right to the upper edge of the expected move and broke through the upper edge of the expected move, reverted back a little bit here, right pretty much the close today. But I wanted you to see upper edge of the expected move. Now, what other products did I want to show you? Okay, this is actually being led by stocks like Microsoft. So I wanted to bring up the QQQ. Clearly, the Qs exceeded the expected move. Microsoft cracks to the upside, reverses, ends up on the edge of the expected move. Just check this out for a second. Okay, Amazon this week closes well outside of the expected move. Okay, what else you got? I wanted to show you this. XHB. People ask, why did you short XHB this week? Because XHB smoked the outside of the expected move earlier in the week. Okay, pulled back inside of the expected move. All right, we can actually show a little bit about ROKU. So ROKU smokes the outside of the expected move. What I found, generally speaking, is that nothing more than big tech, the QQQ, but specifically Microsoft, Amazon, ROKU, Apple. In fact, I didn't even show you Apple in this particular case. All right, Apple. All of the big tech stocks, okay, are breaking the upside of the expected move. They're basically propping this beast up right now. They're just propping the whole market up. But then when you start to look, okay, at other sectors like the XLF, the financials, take a look what happened to the financials. They broke through the expected move, pulled back in. As I said a moment ago, that's actually why I shorted XHB. Go look at the emerging markets. Okay, the EEM. Okay, the EEM, same thing. Broke to the upside, finished pretty much the week flat on the week. All right. Then we come over to the energy sector. The energy sector, that's actually below where it started the week. Okay. And then last but not least, again, IWM. We bring up IWM because IWM cracked to the upside earlier in the week and pulled back hard in today's trading session. I will reiterate to you, okay, you need to see this and you need to pay very, very careful attention because we blew through the upside in a bunch of these sectors, in the XLF and the EEM and XLE. We blew through the upside recently. Now they look like they're about to pull back. In fact, we may be testing the lower bounds of expected move very, very soon. The interesting thing is going to be the NASDAQ. If the NASDAQ is going to come down, and this is why I wanted to key into this for a moment, why I thought you need to see this. If the NASDAQ is going to come down, you're going to know it. It's actually going to be breaking below the edge of the expected move. So to solidify the idea, if we're really going to get some sell side activity, to solidify the idea, look for the NASDAQ and most of the stocks in the NASDAQ, specifically your Microsofts, your Amazons, your Apples, and so forth. Look for them to blow through the bottom side of that expected move. It would have to happen early in the week. I'm telling you, look for it because, again, as you see, we just sold off 30 S&P handles there right into the cash close. So critically important. Again, outlier moves happened this week substantially. We smashed through the upper edge of the expected move and just pulled back hard. And it can be seen, again, the QQQs even pulled back. But when I say we smashed through and pulled back hard, then you look at something like the financials. And the financials, okay, this was all kinds of nutty. The previous week. This week, smashed through the expected move, pulled back really, really hard off of it. Let's see if we get some follow through inside, of course, of the NASDAQ stocks. Last but not least, expected move this week. So we had a big time expected move in this week of trade. What we were looking for, okay, was $125. $125 higher, $125 lower. Did we get it? No, but we came within a stone's throw of it earlier today. We did pull back relatively hard inside of the SPX. The question is, with a little bit of volatility, a little bit of sell side activity, what's the expected move looking like for next week? And again, this is the kind of stuff that you got to pay attention to. Even if you trade on an intraday basis, people don't realize you trade on an intraday basis. We come up to the edge of the expected move, we pull back. Okay, why should you pay attention to that? Because it's telling you, again, if you look at Monday, we have a $58 expected move between now and Monday. That's put on your big boy pants. That's some serious stuff. 7 days out from now, you would think that this week, nothing happened this week. Really? Nothing happened this week, except why are we sitting with 113%, or I should say $113 expected move? That's a 31% volatility. That ain't nothing. $113 expected move. Again, and I'll draw those expected moves and provide them to everybody here at TheoTrade coming into a Monday morning. But $113 move, people, once again, get ready to rumble. This past week of trade, maybe you didn't see what you wanted to see. Right? Maybe you didn't see, some of you are sitting there banking. You're like, come on, big move to the upside. Others of you are sitting no, I desperately need a move down. And, the irony of that is nobody got what they wanted this week. You got, again, really what? And it goes back to here. Massive ranges with minimal movement. But I'll tell you what, we ended the week right to the lower edge of what has been an incredibly tight range. Again, this coming week, look for some volatility, people. The marketplace, you don't have to look too far to see. When the things like the VVIX, okay, we're not just in the VAMA zone. We're in Never Land up here. 110 and above, and the VVIX is heavy volatility. All of the volatility products are pointing to more risk. The bonds are pointing to more risk. Keep your helmet on, okay? This volatility, it might be summer trade, but this volatility, it's not going anywhere, and neither are you. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.